Ever been told that getting a raise might cost you money in taxes? That you'll earn less if you make more? Yeah, that's a lie. And it's one that's keeping people broke. I'm a licensed CPA turned YouTube tax educator with over a decade of experience helping people keep more of their money. And today, I'm breaking down how tax brackets really work. Here's what people get wrong, so you can stop fearing that raise and start keeping more of your income. The U.S. tax system is progressive. That means it taxes different portions of your income at different rates. So when you move into a higher tax bracket, only the money above that threshold gets taxed more, not your entire income. Let's say you're single and you earn $65,000 in 2025. You're in the 22% tax bracket, but that doesn't mean you're paying 22% on all $65,000. Here's how it really works. The first $11,925 is taxed at 10%. The next chunk, up to $48,475, is taxed at 12%. Only the income above that, so about $16,525, is taxed at 22%. When we average it all out, your effective tax rate is around 13%, not 22%. So no, that raise didn't get stolen. Let's run it back with a raise. Say you go from $65,000 to $70,000. Only that extra $5,000 gets taxed at 22%. That's $1,100 in tax, leaving you with $3,900 extra in your pocket. So you're still ahead, way ahead. This myth makes people turn down promotions or freelance gigs, and that's wild because you're literally just handing money back to the IRS. Now let's get tactical. If you want to stretch that raise even further, you can reduce the portion that gets taxed by using smart tools that the wealthy use all the time. Let's say you get a $5,000 raise, going from $65,000 to $70,000. You're thinking, okay, I'm in the 22% bracket now. That extra income is going to get hit hard. But watch this. If you contribute just $2,500 more to a traditional 401k, that's pre-tax, and put another $1,000 into a health savings account or HSA, if you're enrolled in a high-deductible health plan, you've already reduced your taxable income by $3,500. Now, only $1,500 of that raise is taxed at 22%. The rest is sheltered. That's a tax bill of just $330, and you still kept most of your raise and boosted your retirement and health savings. And if you're self-employed, even better. Let's say you take a $1,500 business deduction for your home office, laptop, or mileage. That wipes out the rest. Married? Even more leverage. Filing jointly in 2025 means your 12% bracket goes all the way up to $96,950. So your income has way more room before it even touches that 22% bracket. Same raise, same tax code, but when you plan for it, you win. Here's where people go wrong. They avoid raises due to tax fear. They don't adjust withholding after earning more. They ignore deductible opportunities like IRAs, education credits, or business mileage. Don't let tax myths dictate your financial growth. More income is always better, especially when you know how to manage it smart. If you learned something new today, smash that like button and hit subscribe. This channel is packed with real tax tips from a licensed CPA. No fluff, no fear, just facts. And if you've got questions about raises, deductions, or side hustle taxes, drop them in the comments.